Income policy provisions. Individual disability income policies have several standard provisions. These affect the start of coverage, the start of a benefit period, and the amount of the benefits paid. Probationary period provision. Disability income, DI, policies often have a probationary period provision. A certain amount of time must pass after the policy is issued before the policy covers illness-related disabilities. The probationary period is usually 15 to 30 days. This period protects the insurer from adverse selection, the tendency of risk-prone individuals to buy and keep a policy. A serious illness can motivate a person to buy insurance. Illness-related disabilities arising before the end of the probationary period are not covered, even after the probationary period expires. Accident-related disabilities are exempt from the probationary period. The policy covers them as soon as the policy is issued. Example: Melanie buys a disability income policy on April 1st with a 30-day probationary period. On April 7th, she contracts a serious illness and is hospitalized until April 21st. On her way home from the hospital, she falls and breaks her leg. The DI policy will pay a benefit only for the time she is disabled from the accidental fall. Key point: when a DI policy is first issued, its probationary period must pass before it pays benefits for disability from illness. Benefits for disability from accidents are paid immediately. Once this period has passed, it does not occur again. Elimination period provision. Also called the waiting period, the elimination period must pass after disability begins and before benefits start. Like a deductible, it avoids claims for short-term disabilities that presumably the insured can absorb. This helps the insurer minimize costs and premiums. An insured can choose an elimination period of almost any length. Some insurers don't even impose one. In that case, the policy's benefits are payable immediately after a disability starts, if the probationary period has passed. On the other hand, policies sold to businesses may have long elimination periods. Common elimination periods are 30 days, 60 days, 90 days, 180 days. The shorter the policy's elimination period is, the higher the premium. An applicant who wants to minimize premiums should choose a longer elimination period. Key point: the elimination period must pass before disability benefits begin. It arises every time the insured files a claim for disability benefits. Benefit period provision. The benefit period is the time during which the policy pays benefits. It begins when the elimination period ends. Benefit payments end when the insured's disability ends or when the maximum benefit period ends, whichever comes first. The maximum benefit period is set when the policy is applied for and issued. It can be as short as 1 or 2 years or as long as the insured's lifetime. The longer the benefit period is, the higher the premium. Common benefit periods in disability income insurance policies are 2 years, 5 years, to the insured's age 65, to the insured's age 67, or at Social Security full retirement age. For the insured's lifetime. Some insurers sell short-term disability insurance, STD, with a benefit period of several months to 2 years. So policies with benefit periods of more than 2 years are sometimes called long-term disability, LTD, policies. When setting maximum benefit periods, policies may differentiate between illness-related disabilities and accident-related disabilities. For example, a policy may provide a 5-year maximum benefit period for illness-related disabilities but lifetime benefits for accident-related disabilities. Benefit amount provisions. Disability income policies usually have a maximum benefit amount and a minimum benefit amount. The maximum benefit amount limits the total monthly benefit payable, regardless of the insured's monthly wage and benefit percentage. Example: a policy pays a benefit of 60% of earnings and has a $5,000 maximum monthly benefit limit. An insured who earns up to $8,333 per month would qualify for a monthly benefit of the full 60% of earnings. However, someone who earns more would be limited to the $5,000 monthly benefit, $8,333 times 60% equals $5,000. The minimum monthly benefit is usually a small amount, perhaps $100, that is paid if the insured also qualifies for disability coverage from other sources, such as workers' compensation, that would reduce policy benefits. Recurrent disability provision. If the insured recovers from a disability and is disabled again, the insurer may impose a new waiting period and maximum benefit period. But if the subsequent disability is closely related to the prior disability, the insurer may treat it as a continuation of the prior one. Then the insurer will not impose a new elimination period or a new maximum benefit period. A recurrent disability provision defines a recurrent disability as one that is from the same or related cause of an earlier disability for which the elimination period was satisfied and begins within 6 months from the end of the earlier, related disability, assuming the policy remains in force. Relation to earnings provision. Many DI policies include a relation to earnings provision or participation limit. This limits the amount of benefits the insurer pays if more than one policy covers the disability. The total amount of disability benefits from all policies the insured owns cannot exceed the insured's earnings. Example: Carol owns a personal disability income policy. She is also covered by her employer's group DI policy. The relation to earnings provision in her individual policy will reduce its benefits so that the combined benefits of both policies do not exceed her current gross earnings. Non-disabling injury provision. Some DI policies have a non-disabling injury provision. With this provision, the policy pays for medical treatment due to accidental injuries even if the injury does not result in disability or loss of income. The benefit paid for medical treatment is usually a percentage of the monthly benefit that would be paid for a disability. Rehabilitation provision. Some DI policies include a rehabilitation provision, or a return to work provision. With this provision, the insurer pays for occupational therapy, training, or modifications to the insured's workplace. This helps the insured return to work. Common DI exclusions. Common DI policy exclusions include acts of war, self-inflicted injuries, pre-existing conditions. Note that the ACA's prohibition of pre-existing condition exclusions does not apply to disability income insurance policies. For your review: illness-related disabilities arising before the probationary period ends are not covered, even after the probationary period expires. Accident-related disabilities are exempt from the probationary period and are covered from the moment the policy is issued. A longer elimination period reduces the premium on a DI policy. The benefit period ends when the insured's disability ends or the policy's maximum benefit period ends, whichever comes first. A recurrent disability is not subject to a new elimination period or a new maximum benefit period. The relation to earnings provision, or participation limit, determines the amount of benefits the insurer pays if more than one policy covers the disability. It prevents the total disability benefits from all policies the insured owns from exceeding the insured's pre-disability earnings. Please pause the audio and watch the video. You can restart the audio playback at any time.
It covers and the variety of benefits it provides means that a disability income policy can be quite detailed. To accommodate this complexity, a DI policy has a number of unique policy provisions. The one provision I want to take a moment to elaborate on is what we call the recurrent disability provision. What happens in the not uncommon situation where a person returns to work after being totally disabled only to suffer a relapse of that same disability? Well, is it necessary then to satisfy another elimination period to qualify for benefits? No. Fortunately, most disability income policies include what we call a recurrent disability provision that addresses this issue. To qualify under the recurrent disability provision, which would, by the way, mean that the policy owner would not have to satisfy another elimination period, the current disability must, first of all, be from a continuation, if you will, of the prior disability. It must truly be a recurrence of the disability that they are just recovering from. It must begin within 6 months after the end of the prior period of total disability. And third, and most important, the policy must have been maintained during this period. Now let's just take a moment and explain that last one because it's important. First of all, when a person becomes totally disabled and eligible for benefits under a disability income policy, they will receive monthly income benefits for as long as they remain totally disabled. For the record, the policy owner could cancel his DI policy and he would continue to receive benefits as long as he remains totally disabled. In other words, you do not need to keep a DI policy in force to receive benefits from it. However, consider the impact if the policy owner were to cancel that policy. If a policy owner becomes totally disabled, stops receiving benefits, and, if I may, foolishly cancels the policy, then when they recover, first of all, they're going to be uninsurable. They will never again be able to buy a disability income policy. Second of all, they won't be eligible for the recurrent disability provision because, again, the policy has been canceled. There is no more coverage. So it really doesn't make any sense to cancel a disability income policy when a person becomes disabled. Now, one question a person might have is, well, it costs a lot of money to maintain a DI policy, money that I don't have when I'm disabled. How do you address that? It's very simple. You make sure you add a waiver of premium rider to that disability income policy. That way, if the policy owner becomes totally disabled, the waiver of premium rider kicks in and keeps the policy funded during that period of disability, preventing all of these problems I just talked about from happening. So, my advice is, when you sell a disability income policy, make sure the policy owner includes a waiver premium provision with it. That'll make sure the coverage continues even after the disability is passed, and it makes sure that they're eligible for the recurrent disability provision should a recurring disability occur.
Okay, did everybody get all that? That was a lot, I know. All right, so here's the 4 questions. After a disability income policy has been issued, what period of time must pass? I thought we had this question before on another test. Okay, and I think I got it wrong. I'm going to put elimination period. Okay, a recurrent disability arises when the disability income policy is in effect and with how many months or earlier related disability. Related disability. I don't know. I want to say 3 months. Okay, after Todd was injured in a car crash, he received occupational therapy to help him return to work. His disability income policy paid for the therapy because it had a either exclusion or rehabilitation. I'll put rehabilitation, just as a guess. All right, the elimination period in disability income policy functions like which of the following in medical expense policy? Elimination period functions like. Oh boy, I have no clue. What's the guess deductible or benefit schedule? I don't know which is it. What we want to do these things live, so I don't have to keep guessing. Y'all can help me answer these, and we'll see if we get it right or not. Comment below if you all want to do these things live. I'm not getting any comments. I might get comments by the time after I'm already finished this course, but if you comment before the course is finished, which is we're at 70%, we can do these live, and you all can help me pass, because I only got 50%. Alright, so this one here was probationary period. I know I had this question before, and I couldn't remember. Probationary period. What time must pass before they can file a claim for benefits? Alright, this one here was 6 months, so I was pretty close. Right? That was a tricky one. And they probably will have something like this on the test. So be sure and do your due diligence, and however you want to study. You want to keep watching the video, you want to take a screenshot, you want to write these questions down. However you want to do it, do it. Alright, this one I got right. Rehabilitation provision. By the way, that was a total guess, no idea. All right, so return to work or rehabilitation provision, a lot of these policies have them, and that will allow him to return to work. The next one, total guess again. Got it right. I hope I do this good on the test. All right, deductible. So the elimination period acts like a deductible. The elimination period is the period of time that must lapse before the start of a disability, before the DI benefits become payable. All right, just remember, if you need to study, go review any of these subjects. I'm going to try and put the subjects in the title so you don't have to sit and go through every single video if you don't need to. I appreciate everybody who watched to the end, and I'll see you on the you'll hear me on the next video. Please subscribe, like, share, all that stuff. Thank you.